Good morning, I'm Garry Crole from Sequoia Financial Group. Today I'm joined by a good friend, Stephen Prendeville. Stephen, as most advisors would know, is the go-to person in the industry if you're looking to buy or sell a practice. And today I want to talk to Stephen in particular about what he's seeing in the market and what advisors can do to improve their practice and prepare it for sale, but also what to look out for when acquiring a business and some of the traps. So thanks for joining us, Stephen. What are you seeing in the market at the moment? Is the valuations going up or down, or what's actually happening on the ground?
Multiples are sort of where they have been for the last 20 years,
yes.
With the exception of risk. So as we know, risk, with calling on the lift review, risk went from 3.5 times recurring revenue down to 2.5, mainly because of the uncertainty. It's the risk market which also is fighting a number of headwinds still. And one, waiting for Treasury to come out on what the revenue is. But also with just rising premiums, and lapse rates. It used to be that there'd be a discount if lapse rates was more than 5%.
Yes.
Now if it's 10%, it's deemed to be good. We're in the same multiples, but what's happened is businesses have transformed over the last even couple of years. Has been marked difference. Everyone's had to re-engineer. So while multiples may be the same, we're seeing higher prices purely because the revenue has grown, the profitability has grown, and also confidence from a buy side is we don't have legislative uncertainty.
Yes.
We're actually now starting to get into a period where, with the banks exiting, we've got the restoration of trust and confidence of the public. We've got rising organic growth at the same time. We've predominantly over 80% of the marketplace has moved to fixed fees. Fixed fees also means fixed margins.
Yes.
And more robust businesses. They're no longer exposed to market or economic inputs. They know from the 1st of January what their results are going to be by the 30th of December. And so we've got, re-engagements. Whilst it's a administrative nightmare,
Yes.
it actually means that we've got only active clients within it. So again, there's confidence. There's been a lot more, I suppose, businesses specialising in what they do. We've seen growth of outsourcing,
Yes.
and so they focus on what they're good at. And asset management's outsourced, paraplanning's outsourced, marketing and social medias, and so profitability. Just in the last 2 years, we've gone from average 24% to now 28%.
So that's a sort of the gross revenue.
Yeah, EBIT levels.
24% to 28% on the revenue is the EBIT margin.
And a lot of business I'm seeing are operating well over 35% profitability.
Yes.
They've re-engineered the businesses. What we've done over the last 5 years is we've built better businesses, and principals are being rewarded by better prices. Not the multiple, it's just that their own performance has increased.
Yes. And on the discussion about the trying to reduce the cost of advice, what are the buyers looking for in respect to the average fee? So is there everyone says to me, what do you charge? How much should I charge per client? Is there something coming through on the sell side that advisors are looking for practices that are charging X, Y, Z per client per year to justify that profit margin?
Yeah, so the average fee in the industry is around $3,500. And what we're seeing is some buyers are not placing any value on annual recurring revenue at 2.5. They're going, I can't make profit on that.
Yes.
Now in transactions, the upfront component ignores that level of revenue because it's either going to go or it'll be rewarded if that revenue goes from say 2.5 to above 3.5 or 4.
Yes.
And that'll be in the back end. So buyers are looking at, have always looked at age demographics.
Yes.
But now they're getting a lot more granular as to what service is being delivered and at what cost, and therefore what's the profit per client. So that's a real sort of subtle change.
And is there any criticism about charging too much? So, the risk of clients that you acquire putting pressure on you to reduce fees?
There doesn't appear to be.
Yep.
what we've seen in the last couple of years is probably fixed fees have increased by 30% in the last 2 years. And that's probably why we've also seen the same sort of shift in profitability of businesses as well. It is true now that whilst the average fee may be 3.5, most of what I'm seeing is 5.5.
Yes.
And averages always get blurred, but what I'm seeing on valuing businesses or selling businesses, it's probably getting up to 5.5.
Yes.
It is making, as an industry, harder for consumers to access, but the value propositions have also substantially increased. Whilst the fees have gone up, so's the service.
Yes.
And it's a lot more tailored, a lot more individual. We've seen advisor-client ratios last couple of years has been somewhere around 130. So 130 clients per advisor.
Yes.
And that advisor is normally supported by his 1.5 staff.
Yes.
So there's really good service delivery being there. We've got a lot more specification in asset management. So the adoption of managed accounts has also transformed back office and increased efficiencies. But one of the better stories from the managed account stories is the specified or specific communication with clients.
Yes.
They can talk about your portfolio, we've just done this, we've moved this out, we've added this.
Yes.
And people feel a lot more connection to it. And so messaging is a lot more specific rather than they, maybe once a month newsletter or 6 monthly or annual.
Yep.
Now, and also clients are picking what mediums they want to meet on. Is it a Zoom meeting? Is it face-to-face? And we're also advisors and a lot more specific. For the next 12 months, this is what we're going to achieve.
Yes.
It's not that old conversation we used to have of, your portfolio's done this in the last 12 months.
Yes.
It's actually lifestyle goals that are being articulated.
Yes.
And that's where we're being judged on of, have we delivered this?
Yeah.
So I think it's more expensive, but the service, has also moved comparatively as well.
Yeah, so it looks to me like, being an oldie, going back through a little bit, and you've seen it all. I know we were talking about buying and selling businesses maybe 15 years ago. So things have come a long way. But one of the things that it seems to be occurring is people are selling a business now opposed to selling a book. Yeah. And what are they doing to create this business? So a lot of our advisors, for example, sit in the 300,000 to 500,000 income band, which tends to be the place where people use an outsourced license to operate. Yeah. What are those guys doing? Because you've got only a certain amount of dollars to be able to employ staff and have all these things. How do you get from that 300,000 to 500,000 income band and begin outsourcing and beginning employing someone to having a business as such rather than a client book?
Yeah, so probably 70% of businesses I sell are share sales, and that's primarily with the vendors focus on capital gains tax and net return. Yes. And it's easily mitigated in warranties and indemnities. So that's just the technical part of a transaction. With regards to the sub 500,000, it's easy to talk about 1.6 or 1.8 being the average revenue, but 45% of our industry is operating at less than 500,000. Yes. It's the area which there's now. I think some of that sub 500 is also lifestyle decision. For those that it's not a lifestyle decision, they're inhibited purely because they don't have any flexibility within their P&L or balance sheet. And they're restricted because they can maybe see the opportunity, but they don't have the capacity to take on clients. What we're talking about is potentially one client a month sort of productivity. Yes. And depending if it's a mature business, if it's take on one, it's drop one. Yes. And so they're locked in to this area, and it just means that they're exposed to markets. For instance, the one that we all saw was removal of grandfathered revenue.
Yes.
Now, for many businesses, that was a 30% hit straight away.
Yes.
We also know that the sub 500,000 is that there's nearly close to 50% are operating not at a profit.
Yes.
And certainly not paying them commercial wages, which for metropolitan capital cities is 150,000.
So on that point, just quickly, is when you're looking at the financials, are you looking for advisors selling their practice that are actually paying a set salary? Because a lot of these guys just take out what's left.
Yeah, agreed. So so what we assume is that depending upon location,
yes,
and so the vast majority is capital cities or metropolitan, we assume 150,000 salary.
Right.
Now, for this group, the sub 500, obviously we're not selling on EBIT, we're selling purely on recurring revenue.
Yes.
The buyer is not overly interested in the profitability of that business because they're going to pick that business up and put it into their existing infrastructure, and it becomes profitable immediately. We assume a salary of 150 simply because that's what it'll cost to have a senior advisor looking after that client base that's now been embedded. So it can be unprofitable or break even, but that's why that market is sort of easy tuck-ins, as what's referred to.
Yeah, I always used to use a bit of a rule of thumb on that point, whereas a third, a third, a third. So if you're buying 130 clients at $3,000 odd, $500,000 revenue, a third would be salary of a person, a third would be your costs of operating, and a third is your profit. So you get to your 33% EBIT margin, in theory. So would that be possible if someone bought a $500,000 practice to then go and employ someone at 150,000 to go to the next level? Are you seeing any of that?
Look, it might be possible to maintain the status quo, but not potentially to grow it. That's where it needs the capital. It needs marketing, branding, it needs systems and process, constant sort of evolution. And this is the inhibitor. This is one of the reasons why we're probably seeing now maybe over 60% of our transactions, the principal actually wants to stay.
Right.
And buyers are really comfortable with that. But it's because they want to be released from all of the responsibilities of being CEO, CFO, compliance, and marketing, and all the different hats that any business owner has to wear. That all they want to do is be an advisor. They're really good at it.
And a lot of them haven't had a holiday for like 15 years.
Well,
they can't leave.
Yeah, key person dependency. It's single basically operator with maybe one or two support staff. At 500, you're probably looking at one. What you can do is this outsourcing. But I think that also in that sub 500, there's a sort of a fear factor of, what if I make a mistake, because there's an investment, be that outsourcing of media or outsourcing of para planning. Most of those groups will also be within dealer groups, and rightly so, because then they're getting the cost savings of a lot, PIs being reduced, but also they're getting the compliance overlays. They are getting, hopefully, business coaching, because that's the one that can give confidence to come out of a comfort zone and break into from 500, break in 500 plus and into that million. But to do that, you need help and support, and but the absence is capital. But there's a lot of capital happening. What I'm seeing a fair bit of is mergers, where people have maybe within a dealer group, they like and respect each other and going, well, let's come together. When I'm advising on that, what I'm saying is, well, like anything, you're entering into a relationship, live together for a year. So go into an office sharing agreement, which that means you're sharing the rent, you're starting to share staff. And then you also hopefully are building commonality of back office efficiencies. You've already got hopefully shared so that your business practice become aligned. Yeah. Then potentially there's evaluation and emerging in a new entity.
Yeah, well, you get lots of benefit, don't you? You get one PI for the practice, you get a lower dealer split.
You can take holidays.
And you can take holidays,
you've got someone back, with looking after your back.
Yes. And there's no capital exchange or a sort of a
and
share
that sort
ratio
of one is probably
based
going
on...
to be a share ratio.
Yes.
What you're hoping for is that the parties that are coming together also have the same time frames. Yes. This is where we want our business to be in 3 years, 5 years. I'm looking at retiring in this period of time. Yes. At which stage the business will be this, we can bring in someone, so they talk about it at the stage. So I think that's essential. It's the only way that you can start to get potentially with coming together more robust P&Ls and balance sheet to be able to start to be a little bit more creative, start to have confidence of investing in the future, be it people or processes.
Yes, and before you touched on the warranties, etc.
Yeah.
So on general insurance, it's always been quite simple. They have sort of a rise and fall clause on the income. What are you seeing there? So my experience has seen that the second payment has often been a challenging discussion between parties because parts of the book leave or all sorts of things occur. So what are you putting in your contracts and helping both buyers and sellers protect themselves on that? Sure. And what is the upfront pay? So how much upfront are people getting and how's that working?
Sure. So the average is 70% and upfront. Yep. Now with the sub sort of 2 million purchase price, yes, it'll be a 12-month contract. So there'll be 30% will be paid in 13 months, yes, dependent upon the 12 months recurring revenue. Yes. Now and that'll be a rise or fall. Yes. And so whatever the recurring revenue, and even if it's been sold on EBIT, we use recurring revenue because that's the best determinant of client retention or attraction.
It's almost impossible to do EBIT.
Yeah.
In a new
you can't do EBIT because they might bring in the new company yacht or something, and blow up EBIT. Yes. So what you've got to do is the contract basically is what you can manage and what you can see. It's also reported monthly. So, and that's where a lot of people fail on the buy side, is providing the vendor what the monthlies are. And then there could be a shock factor down here. But the reality is that the principal should be in the business or very, very close to the business over the 12 months or the term of the contract. Yes. So they've got line of sight. The other part of it was that more buyers are actually encouraging that. They used to sort of think, get rid of the principal almost immediately. Yes. Now, with the talent shortage, they're going, okay, we can actually use you. But the other part of it is you get a lot of higher client retention because you also get higher staff retention if the principal is actually left in place. Yep. And what we do for protection is one, monthly reporting. The second one is we have what's referred to as the maintenance of the status quo. So if I take a business to market, there'll be 50 inquiries. Yes. Only 5 will get to meet my client. Okay. And how I've selected those 5 is that there's business models are very similar and that there's a lot of compatibility. My client will meet the 5 and they will tell me who they like the most. Yes. Now I know that sounds soft, but
it's important.
Yeah, you've got to be able to sit confidently around the table. Yes. And like and trust the person on the other side. Yes. Yes. And so I'm relying upon my client to tell me I like this person or trust them. Mm-hmm. And then my part's to look after the negotiations and the contract side. So we've got cultural tech, now we're going to make the commercial. So the first one is, as I said, reporting. Maintenance of the status quo, we already would have known. So we're going, okay, well, we don't want to potentially change staff, so all staff must be employed contractually. Yes. The second part is that we want to maintain the same service and fees.
So on that point, sorry to interrupt.
Yeah.
So do the staff transfer their rights or does the seller pay out the old
So yeah,
Right.
the vendor will pay any staff entitlements, and the staff will, in most cases, enter into a new employment contract, which will have new non-solicitation and restraint clauses within that employment agreement.
Yes.
Because they're not signatories to the contract.
Yes.
So a new employment contract will look after that part of it. So maintenance of the status quo could be staff.
Yes.
It could also be fees.
Yes.
Now, if there's going to be a fee increase, we want to know why before we transact.
Yes.
We want to know what change elements are going to be happening to that business. Yes. So, and then if the buyer's saying, okay, I want to change this, and the vendor goes, yeah, look, I agree, be it potentially a movement to an MDA or introduction of new services, fine. But that's where we've got to have transparent and honest communication, because then we'll lock it down and saying, okay, so no fee changes, potentially no service changes, no location changes, no platform changes, unless there's again, client's best interest will overlay.
Yes.
But what we want is when a business is transitioning, when it's gone, it is actually changing. What we're seeking to do is to ensure that from a client's perspective, there's a very little change.
Yes.
As soon as and this is how you communicate to the clients, that's going to also be in the contract.
Yes.
We normally will not say that there's been a sale, we'll say there's been a merger.
Yep.
So clients don't feel like chattel.
Yes.
We say nothing's really changed, we're just getting better and bigger,
yes,
and have greater resources. This is a good story. And the reality is, our vendor absolutely believes it will be.
Yes.
Our starting position is when we're selling a business is actually what we're doing here is we're finding the best advisor for the clients and we're finding the best employer for staff.
Yes.
If we do those two things, we'll look after the vendor and their family.
Yes.
But you've spent 20 years looking after these clients, you love the staff,
yeah,
we're not putting anything at risk here.
Yeah, makes sense.
And the legacy continues.
And you're representing both buyers and sellers separately?
No.
Or you're a seller's agent?
Yeah, I'm just a vendor advocate only.
Okay, right, okay. And how do you get paid?
By the vendor when they get paid.
Right, okay, so you're acting fee for service?
Yeah, so I'll have a look at a business and I'll go, okay, how hard's this going to be?
Yes.
There are upfronts, which is the creation of the information memorandum.
Yes.
At the same time we're creating the information memorandum, we're also creating the data bank for due diligence.
And you've got all the legal documents as well, is that right?
So what happens on that is I'll call through the process, we've got our 5, I'll call for indicative non-binding offers.
Yes.
So my clients ticked off who they want culturally, so that could be 3 parties.
Yes.
Of those 3, they've also then, I've been able to tick off, yes, they're commercial. Their offers are commercial, and then we go into DD. They come out of DD, which is now normally probably 2 to 3 weeks. They come out, we call for final offers, and then we're just, again, checking that we've got the commercial elements. From that, I will create a heads of agreement, which is plain English, all the items that we're likely to see within the contract.
Yes.
So it's covering staff, location, work in progress, the methodology of calculation of any deferred component, what's actually being sold, is it an asset sale, is it a share sale, is it a capital gains tax, GST event, whose responsibilities are that. So everything that's going to be found in the contract will be reflected in the heads of agreement. We sign the heads of agreement, deposit is paid, we go into exclusivity at that stage, and I've worked with a lawyer for now 17 years.
Wow.
And he has and I'm talking about a lawyer, has my absolute confidence and trust.
Yes.
I went through 3 years of trying to find, but then there'd be lawyers, there'd be all of a sudden be quote for 15 and it comes out at 25.
Yes.
Just that creep on.
They have less scrutiny than we do in our advice fees. It's quite amazing, isn't it?
So my lawyer, Narendra Sani, he's probably looked after almost every one of my clients.
Yes.
So that's well over 200. He's probably done more transactions than most commercial lawyers within the sector. And he's not trying to add anything. What he's trying to do is make a really neutral document, because we've got the blueprint of the heads of agreement. Yes. He's not looking for a fight. Yeah. He's looking to protect the interests of his client.
Yes.
And also, with most of the buyers now are multiple buyers.
Yes.
And so we know their lawyers. Yes. And so we'll just pick up the last warranties and indemnities that we negotiate and put them straight in. Yep. We're trying to do this and ensure all parties are protected. But two, that also the goodwill that's been created between the buyer and the seller is also maintained.
Yes.
So while we're going through contracts, I always get the buyer and seller to be talking about transition planning. Okay, how are we going to do this? On which date? How do we transfer data? And because that's positive. You're talking about the future.
Yeah, that's good.
While all the sort of dark arts are working with the lawyer to lawyer. And on that, with what I find is it's got to be a clear communication. So Naren, the lawyer I use, will come to me and say, Steve, we've got this issue. Then he'll say, we can do this, we can do that. I've probably seen the issue before.
Yes.
I'll go to my client and make a suggestion which I believe is the middle ground. And then I'll go to the buyer, tell them about the issue, talk about the solution. We'll come to an agreement ourselves, and then buyer and seller instruct their lawyers. I don't have lawyer to lawyer.
Yeah, no, good.
Because that's when you get bills blown out and all of a sudden you've got a negativity that needn't be there.
No, that's right. No, that's good. And maybe just a couple of last points on the mergers within dealer groups, because that's a challenge in itself. Are you acting as consultant to parties there? So if we've got a couple of advisors that are thinking about merging but don't quite know how to do it and how to strike the ratios and the agreements and etc., is that something you're participating in?
Yeah, it is. Normally what it is
because there's no transactional income, you're just charging a fee?
Yeah, so one is you talk about, live together.
Yep.
So that's free advice.
Yes.
And then it's probably you're entering into a service agreement.
Yes.
You need to have a look at what the dealer support levels are, but there'll probably be some legal sort of agreement just on a service.
Yes.
If they then decide that, yes, there's going to be an equity event,
yes,
I'll normally come in at that. I could be at the start just telling them how to and why, and is this the right person? Are you sure about it? That type of one. And if there's going to be an equity event, I'll value both businesses.
Okay.
And that's probably where you have your great splits. And then you've got to talk about, going forward, what happens if one's producing more than another? What happens with income splitting and partnerships? And so that sort of ones, if it gets overly complicated, maybe I'll bring in an accountant or someone that, but it's normally you must have a shareholders agreement.
Yes.
Too many times it's a handshake then a headache.
Yeah.
And it needs to be a live document.
Yes.
And right of first option to buy the other half or whatever the shares are. What levels of salary you're going to be paying each other for different roles. When you have those sort of conversations and one all of a sudden is getting paid more from another, or there's a difference in dividend splits, that's when it really starts to get tested.
Yes.
But you don't go through that sort of stress testing until you're both comfortable, you've lived together.
Yeah, I think that's important because I've seen the amount of partnerships I've seen over the years where one partner feels he's doing all the sales and the other one's doing all the back office, and
not getting recognition.
How come I only get half of the income when I'm doing all the sales and all those arguments? It's
so you've got to head those off. And again, as you said, as observers to multiple businesses, you actually know where it's going. Also, I've got better experience with the partnership as well. Which,
I recall.
So you learn lessons along the way as well.
We do.
It's the mistakes that you remember.
Yes, yeah, no, absolutely. And maybe one last point, a lot of advisors are using platforms, Net Wealth Hub 24, Centric, Premium, etc. Is that important in respect to the business valuations? People, the ease of providing the service, is that a factor?
Absolutely. So, but maybe not in the way that most would imagine. It's more of a factor because of the efficiency gains and that communication piece that I spoke about, and the client sort of level of engagement. So a buyer might have net wealth and the other party might have hub. Value propositions are relatively the same. Client's best interests is the number one. If there's not a clear value prop, then yes, you'll have two different platforms from it. Now, the reality is that they're not that different. And my apologies to Hub and to Net Wealth. I'm sorry, mate. But so you look at it, but it's more about how they transform business efficiencies. At one single instruction through the whole portfolio, rather than 300 letters going out to clients and waiting for them to sign it and return it. That
hard work.
That frees it up.
Yeah,
so
absolutely.
I am a managed account advocate, but agnostic. As
so
long as
off-the-shelf managed accounts rather than the practice managed account.
It depends upon the level of intellectual property within a practice. I like the idea of having outsourced asset management, but if you're going to have it internally, then you've got to have all the corporate governance that comes with it. You've got to have third parties that are on your investment committee, and that's where the buyers are getting synergy benefits. They do have it, and they normally have their in-house asset management. It's advice is no longer scalable, and going back to that advisor-client ratio, asset management or funds management is, and the value chain is that you can pick up another sort of, let's say 20 basis points, but you actually actively have to work for it. You actually do have the investment committees. You are deciding which platforms, you are deciding which asset managers within which sectors. You're doing all of that, so you are earning it. And again, that's where the vendor must know what this buyer's motivations are, but quite often it will be now asset management is an important piece. The platform itself, not so much. It's just the efficiencies and services.
I'll just finish off with the last one. Like, one of my friends is a real estate agent, and he knows when the house is coming up for sale because they start doing the garden and the painters are in and all those sorts of things. So what are 3 tips that you might give someone who's looking to sell their practice in the next 2 years to make their asset more appealing?
Yeah, it really happens now, but all files must be digital. I think that most people accept that. We are working in a paperless office.
So X-Plan is important?
X-Plan's, that's 80% of the market. No one's overly comfortable with X-Plan, buyer or seller. Normally there'll be maybe a part of the tech stack will be a CRM. It's the CRM which is critical. If there's any preparation that you're going to do, ensure that the CRM has all the contact details. Age is an important determinant to value, but also occupations. And couples, what they're doing, their income levels. You want the more transparency that you have around what the client base on an individual and collective basis looks like, then the greater amount of confidence that a buyer will have. CRM's vital. And then it's just sort of, in prep, you can't sort of, dress it up by all of a sudden cutting costs or doing anything like that. Buyers are educated. They're looking through and going, is this sustainable revenue? Is this sustainable profit? If it's not, they'll input costs. But it's making sure that you've got the systems and processes. Which is great at the moment is that the vast majority of businesses that I'm representing also are growing. So yes, I want to retire, but that's not the time to start putting your feet up and your hands behind your back. You actually want new growth. And that gives confidence to any buyer.
Yes.
If a business is flatlining because the energy levels have, then it's starting to raise questions, because if you're in this marketplace, if you're flatlining, you're actually declining. It means there's no innovation, there's no dynamic, you've got staff that are sort of locked in one place. You need to grow, and particularly when there's opportunity. So CRM, growth, it's marketing, ensuring that the energy's there, systems and processes, that it's the best it possibly can be.
And are people focusing on websites, or is that
look,
important?
it's websites obviously important and need to be refreshed,
Yes.
but it's mainly for clients to be able to use it. So
Yes.
client portals are absolutely vital.
Okay.
One for basically cyber security
Yes.
is primary. And buyers are looking at that as well. But it's more about that it tells the story, and it's also that your website reflects your social media, and that you've got messaging that looks the same. So you might be on multiple different social media platforms,
Yes.
but your website needs to reflect the messaging that's there and the imagery. So that's just having a cohesive marketing identity.
Yeah, terrific. Thank you, Stephen, for joining us today. And if people want to make contact with you, we'll there'll be a slide up on the screen now, and you don't mind advisors contacting you and having a chat.
Even if it's just if it's 20 minutes or just thinking about this, what do I do, type of thing.
Yes.
Always happy to have a chat. No problem at all.
Great. Good to see you again, and I'll see you overseas shortly.
Yeah, look forward to it.
Great. Thank you, Stephen.